Hello everyone and welcome to this week's YouTube video. There's a persistent volatility in our markets and some major events have recently happened. But the big question that we keep on getting from our investors is, what is the expectation from the market in the next few years? Where do you see the market going? And what is the implication of these big events? So in this video, we're going to talk about the recent rate cut, the announcement from the budgets and where they are taking the economy, and everything else that is happening in the macroeconomic scenario with Donald Trump's policy and the slowing growth outlook for India. The recent rate cut by the RBI of 25 basis point, bringing the rates down to 6.25%, was expected by the market. And therefore, we did not see too much movement after this rate cut was announced. So while lower rates definitely would stimulate the economy, there are still issues on global uncertainty, less liquidity in the market as well as inflationary risk. But along with the rate cut, the recent budget has put focus on consumption as well as infrastructure spending. And these could play a crucial role in India's economic forecast. Meanwhile, globally, US President Donald Trump's protectionist measures are putting pressure on global trade. He's working on corporate taxes and cutting down a lot of government spending across the US. The hawkish stance by the US could have persistent effect on volatility in the emerging markets like India. So let's break down what that means for investments and the road ahead. So let's understand the RBI stance first. The RBI, while it has cut rate, it has also given a positive news by revising the growth projections for the GDP from 6.4 to 6.6%. The inflation projections have also been cut down from 4.4% to 4.2%, indicating that while the food inflation might ease due to the strong Kharif season, there is still a pressure on inflation that could persist due to the global trade uncertainty. Here, Donald Trump's policies, where he has spoken against India in terms of tariffs as well as trade restrictions, could put a pressure on inflation. So the RBI is also being cautious on that front. Let's talk about the liquidity conditions, the credit growth, as well as the budget's role in the economy. Despite the rate cut, the liquidity in the Indian market remains very tight. The catch here is that even though the rate has been cut by the RBI, the banks will not pass on that rate unless they see positive offshoots on credit growth as well as deposit growth. The RBI has actually flagged down the muted urban consumption and a limited fiscal expansion, which could be a worry for the Indian economy. What has been excellent is that the budget has actually come and tried to boost urban consumption by putting money in the hands of the middle class by these massive rate cuts. So as the effect of the rate cuts penetrate the economy, there would be more money in the hand of consumers to spend, and that could actually give an uptick to the consumption theme. And talking about consumptions, in the recent times, what we see is that consumption has become a stronger theme compared to capex or infrastructure spending in the Indian market over the past few months. And that is a trend that we see continue. And that is where we see the focus in our portfolios also shift. The market actually did not react very positively to the rate cut because many participants actually anticipate a liquidity crunch. There were no further liquidity measures announced apart from the rate cut, and people expect the liquidity deficit could go up to 2.5 trillion in the next few months. The RBI could in fact intervene again with open market operation FX swaps to maintain liquidity into the system. And in the meanwhile, Donald Trump's protectionist policies are leading to money leaving emerging markets like India, and that could put further pressure on liquidity in a country like India. So watching out for liquidity in the market is also a crucial thing that we have to do. Now, obviously, people are worried about volatility and they expect the sentiment to be muted in the next few months. What we have to recognize is that the volatility could persist because of US protectionist policies. Money is leaving and FIIs are selling in stocks, especially due to the muted earning growth in India. RBI has also come up with a neutral stance where they've said they will be cautious about future rate cuts, and that could provide limited stimulus to the risk assets in India. Now, what could be a game changer here is the recent budget where the government has put money in the hand of the people. which could in fact lead to a consumption growth. And actually, the dividend that India has of its massive population, its growing middle class, could shine despite all the global macroeconomic pressures. Donald Trump's protectionist policies will have an impact. We could see the tariffs again come back to China and Mexico, even though they have delayed it by a month. And people expect retaliatory tariffs being imposed to different countries, maybe on India, which put tariffs on US imports. So that could be one thing that keeps on impacting investor sentiment. And we have to maintain a cautious stand and maybe switch towards the sectors that are more linked to the dividend coming from domestic consumption. Let's quickly talk about the fixed income market as well as the currency markets also. The bond markets reacted positively to the rate cut, with the yield softening and the long-term bonds becoming more attractive. However, along with this, the rupee continues to be weaker. We've seen the rupee touch 87 versus the dollar, which is influenced by the capital outflow as well as the stronger dollar. Investors who actually have exposure to the global markets have to factor in this currency fluctuation. We do expect the RBI to manage the liquidity, manage the currency fluctuation by other operations, like we said, the open market operations and the FX swaps. And what is the big thing that now we actually have to watch? We've seen the budget happen, we've seen the rate cuts come, a couple of positives that have come into the Indian economy, but the big uncertainty remains with what is going to happen with this trade war being waged by Donald Trump. The US Fed's direction under Donald Trump's administration will also have a big impact on the emerging markets like India. If Donald Trump is able to put pressure on the Fed and that inflates commodity prices, that could have a reactionary measure on a country like India. So in this market, we actually also have to watch closely the commodity market as well as the crude market, because these two sectors could also fluctuate and you could see prices rise due to the inflationary policies under Donald Trump. So with everything in mind and all that we know about the global economy, what are the sectors and the themes right now that we could focus on? Obviously, India has some very attractive segments from the cyclical side, from the infrastructure side, as well as the consumption themes. But what we have to understand is which sectors are better positioned in the current volatile environment. The first sector that is positioned well is obviously the banking and financial services. The recent rate cuts happening will boost the NBFC as well as the banking sector in India. They could lead to credit growth, which has been slowing down. But on the other hand, the margins could shrink because of the floating rate loans. Now, getting a direct effect from the rate cuts, we could see the real estate segment also do well because now loans will be available cheaper. Once the rate cuts pass on to the consumers, you could see the demand for real estate, which is already booming, increase in India. Once the rate cut pass on to the consumer, the auto segment also could have an uptick because people will have more money to borrow to buy cars. Now, for the infrastructure and the capital goods space, while no increase in budgets were announced in the recent budgetary announcements, the infrastructure budget for India is still relatively high and there were no cuts made on that front. And with the stable rate environment and government's focus on capex, you could see the infrastructure and the capital goods space also do well. Now, one big theme that the budget has brought to the forefront is the consumer discretionary theme. If you saw the budget, on the day the budget was announced, we saw an uptake in stocks like Zomato, Trend, etc., which are linked towards the urban consumption theme, and the budget's focus on increasing disposable income. You could see a higher growth in high value consumption goods, and the consumption theme could actually get stronger in India. Now, one big theme that we have also seen a focus is on the rural side as well as the agriculture side. The rural demand has actually seen an uptick, which is a big positive. And the budget actually increased focus on rural development, farm productivity, as well as direct benefit transfers to farmers. And that could benefit the staples as well as the agriculture linked economy, the agrochemicals, the seed manufacturers, etc. Another big thing that was announced in the budget was delay in the stricter LCR and project financing norms till the next year. And that means that the funding constraints on the infrastructure and corporate borrowers goes down. And they could also benefit from the recently announced measures. Along with these sectors, like I said, we also have to keep a watch out on the commodity segment, because in Donald Trump's policies, which inadvertently the trade war becomes inflationary, you could see some demand in the commodity as well as the petrochemical space. So that was all about the RBI's announcements, the budget, the global arts, as well as the sectors that look attractive right now. But now let's talk about what do we see in terms of performance from this market going forward. What we believe is that the two recent announcements, one on the tax cuts in the budget as well as RBI's rate cuts, will have a positive impact on the economy. But maybe the effect of these two policies will come up after a quarter or so. But on the sentimental side, there is more reassurance towards the market. There's a sentimental positive, and the pace to recovery from here will depend on the corporate earnings, the fiscal growth, and obviously on the global trends. As investors, what do we feel confident about? We believe that there are certain segments and industries in India which continue to grow strongly despite all that is happening. And many of these industries are slightly defensive in nature, maybe linked to the consumer led segment, linked to the capital market segment that is doing well, linked to the agrochemicals, as well as to some strong themes. For example, the healthcare and the hospital themes in India. What we expect is the recent announcements has eased a little bit on the sentimental side for the market, and we could see recovery in the small caps names, which actually saw higher drawdowns in the fag end of January. So while you see that the recovery happen and the market bottoming out, at least for the short term, the pain could in fact persist due to the global uncertainty and the slow economic growth in the current market. There are selective industries that we have talked about which continue to look attractive, but you have to keep a focus on identifying companies with strong quality, strong growth, as well as strong future projections. Valuations have to be strictly watched out in this tight liquidity environment. There's not a lot of money flowing around in the economy, and companies cannot justify high valuation unless you see strong earning numbers come in. And what we have to watch out for right now is the companies as well as the industries where the capex has been strong, where the growth is still going strong. We have to focus on the two big themes which have come up recently. One is the consumption linked theme. The rural demand is picking up. Urban economy will be supported by the rate cuts. So the consumer linked themes will continue to be strong. And along with it, the agriculture, agrochemical theme could also look attractive. We also can continue to hold the rate sensitive sectors with the rate cuts coming in and the RBI actually saying that in the next year, they could cut rates by another 50 to 75 basis points. The rate sensitive sectors, right? For example, the banking NBFCs as well as the borrowers like capital goods, autos and real estate, you have to keep a focus on these segments as well. We have to watch out for the liquidity environment as well as we have to actually track couple of things very aggressively. One is the liquidity environment, how the currency is moving, because that is crucial. And also, obviously, what is happening in the global economy and how that impacts India. With Donald Trump policies, which raise a trade war in the global market, that can in fact be inflationary, even though in the recent times, Donald Trump has put a lot of focus on cutting US spending. If he rages a trade war or puts pressure on the US Fed to cut rate at a faster pace, that could lead to higher inflation in the global market, and you actually have to watch out for that as well. In this environment, keeping an eye out on the commodity segments, the metals, the oil and gas is also pretty crucial. So as a final thought, RBI's policies, even though they were priced in and maybe lacking on some measures to boost liquidity, they have come as a sentimental positive. They have eased investors' fears. And along with it, the budget's policy on infrastructure growth, on agriculture growth, as well as big focus on urban consumption could in fact keep our economy relatively stable and growing. The delay on pressure on the infrastructure and corporate borrowers has also been a positive, and that will also boost sentiment in the industry. So while we've seen a couple of very positive news come out in the Indian market, and we are seeing a recovery in the stocks that saw a decline, we still have to be very cautious about the external factors. The US policy decisions are going to have an impact on the whole global market, and they could impact India's currency, liquidity, as well as the external flows. That could in fact lead to this volatility persisting a little bit, even though selective themes right now, especially in the consumer space, agriculture space, rate link space, have definitely gotten more confidence. So more than ever, it is very important for us to understand the macroeconomics, understand the sectoral tailwinds, and be tactical in our approach. And while being tactical, it is also very important to focus on the fundamentals, understand the underlying growth of the companies and their potential in the long term. And that will enable us to navigate this period of volatility a little bit more expertly, with a little bit more sense of safety, and position ourselves to take advantage of growth in this volatile environment. So that was a quick overview of the recent announcements that have come in the economy and our outlook what might happen in the near term. So in the near term, we have got a little bit of a sentimental positive. We have got confidence in some of the consumer as well as rate link segment, but we actually have to be quite cautious. And in the long term, we do expect India's growth to pick up and the market to have an emphatic recovery. If you like this video and if you would like to see more videos, please subscribe to our channel, hit the like button and share it across to all your friends. I'll see you again in the next video. Till then, happy investing.